credit limit is the maximum amount of money a lender will let you borrow. Think of it like your spending limit on a credit card. This limit is set by the credit card company. You can only spend up to this limit. It's important to stay within this limit. Going over can hurt your credit score. Lenders set credit limits for different types of credit. These include credit cards, personal loans, and lines of credit. The limit is based on your credit worthiness. This means how likely you are to repay the debt. Credit limits apply to various borrowing options. Understanding these limits can help you manage your finances better and make informed decisions about borrowing and spending. Let's look at some common types. Credit cards. These are perhaps the most well-known and widely used form of credit. With a credit card, you get a card with a set spending limit which is determined by the issuing bank based on your credit worthiness. This limit dictates how much you can spend using the card. You can use it for various purchases, both online and in physical stores. The convenience of credit cards is unmatched, but it's important to remember that you need to repay the balance. If you don't pay in full each month, you'll incur interest charges, which can add up quickly. Next, we have personal lines of credit. This is like a flexible loan. Unlike a credit card, a personal line of credit gives you access to a set amount of money that you can borrow from as needed. You can borrow up to a certain limit, and you only pay interest on the amount you actually use. This can be a great option for managing cash flow or covering unexpected expenses. You can withdraw funds as needed and repay what you borrow, plus interest. This flexibility makes personal lines of credit a popular choice for many. Another type of credit limit is the home equity line of credit, or HELOC. This is a loan secured by your home, allowing you to borrow against your home's equity. HELOCs often have a variable interest rate, which means the rate can change over time based on market conditions. This can be beneficial if rates go down, but it also means your payments could increase if rates rise. With a HELOC, you can use the funds for a variety of purposes, such as home improvements, education expenses, or even consolidating higher interest debt. It's important to use HELOCs wisely, as your home is used as collateral. If you fail to repay the loan, you risk losing your home. Understanding the different types of credit limits and how they work can help you make better financial decisions. Whether you're using a credit card, a personal line of credit, or a HELOC, it's crucial to manage your borrowing responsibly. Always consider the terms and conditions, interest rates, and repayment requirements before taking on any form of credit. This will help you avoid unnecessary debt and maintain a healthy financial profile. Remember, credit is a powerful tool that, when used wisely, can help you achieve your financial goals, but it requires careful management and a clear understanding of your financial situation. If you're ever unsure about which type of credit is right for you, consider speaking with a financial advisor. They can provide personalized advice based on your unique circumstances and help you navigate the complexities of credit. In summary, credit limits come in various forms, each with its own set of rules and benefits. By understanding these differences, you can make informed decisions that support your financial well-being. So whether you're using a credit card, a personal line of credit, or a HELOC, always stay informed and manage your credit wisely. This will help you build a strong financial foundation for the future. Thank you for watching, and remember to always stay informed about your credit options and manage your finances responsibly. Lenders use several factors to determine your credit limit. This process is crucial because it helps lenders assess the risk of lending you money. They want to ensure that you can handle the responsibility of borrowing and repaying the amount you owe. Here's a closer look at the key factors they consider. Credit score. Your credit score is a big factor. This 3-digit number is a summary of your credit worthiness. It is calculated based on your credit history, including your payment history, the amount of debt you have, and the length of your credit history. A higher score means you're more likely to get a higher limit because it indicates that you have a good track record of managing credit responsibly. Lenders use your credit score to predict how likely you are to repay your debts. If you have a high credit score, it suggests that you are a low-risk borrower, which makes lenders more comfortable offering you a higher credit limit. On the other hand, if your credit score is low, lenders may see you as a higher risk and may offer you a lower credit limit or even deny your application. Income lenders want to see if you can handle the payments. Your income is a critical factor because it shows your ability to repay the borrowed amount. A steady and sufficient income will help you qualify for a higher limit. Lenders typically ask for proof of income, such as pay stubs, tax returns, or bank statements to verify your earnings. They want to ensure that you have enough income to cover your existing financial obligations as well as the new credit limit. If you have a high income, it indicates that you have the financial capacity to handle more debt, which can lead to a higher credit limit. Debt-to-income ratio. This shows how much of your income goes towards debt payments. It is calculated by dividing your total monthly debt payments by your gross monthly income. A lower ratio is better because it suggests that you have more disposable income available to take on additional debt. Lenders use this ratio to assess your ability to manage additional debt. If your debt-to-income ratio is high, it indicates that a significant portion of your income is already committed to debt payments, which may make lenders hesitant to offer you a higher credit limit. Conversely, a low debt-to-income ratio suggests that you have a good balance between your income and debt, making you a more attractive candidate for a higher credit limit. Credit history. A longer credit history is better. Lenders want to see how you've managed credit in the past. A long and positive credit history demonstrates that you have experience handling credit and have been responsible in repaying your debts over time. Your credit history includes information about your past and current credit accounts, such as credit cards, loans, and mortgages. It also shows your payment history, including any late or missed payments. A strong credit history with a record of on-time payments and low balances can significantly improve your chances of getting a higher credit limit. Lenders review your credit history to understand your borrowing behavior and to predict how you will manage new credit. If you have a history of late payments, defaults, or high balances, it may negatively impact your credit limit. On the other hand, a clean credit history with timely payments and low balances can lead to a higher credit limit. In summary, lenders consider multiple factors when determining your credit limit. Your credit score, income, debt-to-income ratio, and credit history all play a crucial role in this decision. By maintaining a high credit score, a steady income, a low debt-to-income ratio, and a positive credit history, you can improve your chances of qualifying for a higher credit limit. Understanding these factors can help you manage your credit more effectively and make informed decisions about borrowing. Credit limits are crucial for both you and the lender. Here's why. Protects lenders. It helps lenders manage their risk. They are more likely to lend money if they know there's a limit on potential losses. Responsible borrowing. It encourages borrowers to be responsible. You need to live within your means and manage debt wisely. Credit score impact. Staying within your limit helps your credit score. Maxing out your cards can hurt your score. Financial planning. It helps you budget and manage your finances effectively. Knowing your limit helps you avoid overspending. Section 5. The dangers of exceeding your credit limit. Going over your credit limit can have serious consequences. Avoid it at all costs. Here's why. Over-limit fees. You'll likely be charged a hefty fee for exceeding your limit. Credit score damage. It can significantly damage your credit score. Lenders see it as a sign of financial instability. Higher interest rates. You might be subjected to higher interest rates on your existing credit cards or loans. Debt spiral. It can lead to a cycle of debt. You might struggle to make minimum payments and fall further behind. Section 6. What is credit utilization and why is it important? Credit utilization is the amount of credit you're using compared to your total credit limit. It's a crucial factor in your credit score. To calculate it, divide your total credit card balances by your total credit limit. For example, if you have a $10,000 credit limit and a $3,000 balance, your credit utilization is 30%. A lower credit utilization ratio is better for your credit score. Aim to keep it below 30%. This shows lenders you're not relying too heavily on credit. Section 7. How to increase your credit limit. You can increase your credit limit over time by demonstrating responsible credit behavior. Make timely payments. Always pay your bills on time. This is the most important factor in building good credit. Keep credit utilization low. Aim for a utilization rate below 30%. Pay down your balances as quickly as possible. Request a credit limit increase. Contact your credit card issuer and request an increase. They will review your account history, maintain a good credit score, monitor your credit report regularly, dispute any errors you find. A good credit score increases your chances of approval. Section 8. Frequently asked questions. How often can I request a credit limit increase? This is a common question among credit card users who are looking to manage their finances more effectively. It's best to wait at least 6 months between requests. This waiting period allows your credit card issuer to see a pattern of responsible credit usage and timely payments. Will requesting a credit limit increase hurt my credit score? This is another frequent concern for many. It might generate a soft inquiry on your credit report, which won't hurt your score. Soft inquiries are different from hard inquiries, which can impact your credit score. Can I use a credit limit increase to make a large purchase? While it might seem like a good idea, there are some risks involved. While tempting, it's best to avoid maxing out your credit limit. Maxing out your credit card can lead to high interest charges and can negatively impact your credit score. Plan and save for large purchases instead. This approach helps you avoid debt and ensures that you can afford the item without financial strain. What if my credit limit increase request is denied? Don't worry. This is not the end of the road. Focus on improving your credit habits. This includes making timely payments, reducing your overall debt, and keeping your credit utilization low. Continue making timely payments and reducing your debt. Over time, these positive financial behaviors will improve your credit score and increase your chances of getting a credit limit increase in the future. You can try again later. Remember, financial health is a journey, not a destination. Keep working on your credit habits and you'll see improvements over time. Educate yourself about credit and personal finance. The more you know, the better equipped you'll be to make smart financial decisions. There are many resources available, from books to online courses, that can help you understand the intricacies of credit management. Consider seeking advice from financial advisors or joining support groups where you can share experiences and learn from others. Setting clear financial goals can also help you stay focused and motivated. Whether it's saving for a big purchase, paying off debt, or improving your credit score, having a plan in place can make a big difference. Celebrate your financial milestones, no matter how small. Each step you take towards better financial health is a victory worth acknowledging. With patience, persistence, and the right knowledge, you can achieve your financial goals and enjoy a more secure and prosperous future. Section 9. Mastering your credit limit. Key takeaways. Credit limits are an essential part of managing your finances. Understanding how they work is crucial for your financial health. Remember to use credit responsibly. Keep your balances low. Make your payments on time. By following these tips, you can build a strong credit history and achieve your financial goals.